Can you see my screen?
Yeah.
Okay. All right. Rules. What are the two rules? Nick, what are the two rules? I'm circling them.
Don't be a pig and manage your margin.
You got it. That's on every slide. It's on every slide for a reason. Those are the two ways that you can screw this all up, right there, either being a pig or not managing your margin properly. I'm guilty of both at one point in time or another, so that's why I know this. Any questions from what we've already covered over from the last session? Remember, I can't see you, so you have to speak up. All right, let's keep going. Next is how to read an options quote. It's kind of like reading a stock quote when you write down to it, except there are a few differences, and we'll just go through all of that. Underlying asset information it should be present on your trading screen for an option. In this particular case, the underlying is the SPX. Anybody remember what the underlying is? Who wants to volunteer that information for me?
Sorry, what was the question, Peter? What did you say?
What is the underlying? What does it tell you?
Oh, that's basically right, the whatever equity or index you're looking at. And
that's right. So if this was SPY, I'd be writing, or I would either be buying or selling SPY options. If this was Apple, it would AAPL, it would be Apple options. If this was Wireless's favorite symbol, AVGO, it would be Broadcom. So the underlying information should be present on your options trading screen in some location. This is from E-Trade. It's actually from an older version of their software. They went and this is now obsolete, but it still looks pretty much the same. Expirations. These are a subset of the expirations. You can tell that this particular chart was done some time ago because you can no longer get November 25th, 2024 options. But there's the number of expirations should be around in some location. Depending upon the symbol, they'll be either daily like this. We have 0DT options for SPX. I believe there are 0DT options for SPY. I'm not as certain about QQQ or IWM, but most symbols have at least weekly options with options expiring on Fridays. Put options I have, in my experience, put options are always on the right. Call options are always on the left, always. In fact, if I was to come across a options trading screen that had that inverted, I would probably screw up. I've never seen it be anything other than this. Strike prices and for the particular options chain. In this particular case, we've got the December 13th, 2024 options chain selected. These are the strike prices that went along with it. Okay. Calls again on the left. Put option prices on the right. Note above this, I don't know if I have this highlighted anywhere, but it tells me how many shares per contract there were. Okay. That information should be available to you too. Available strike prices. If I was in this screen, I could scroll this up or down from what's here. This is just what's showing on the screen right here. Bid and ask prices for calls. Bid and ask prices for puts. What the last executed trade value was for calls. Same thing for puts. Theoretical price. This is just the midpoint. if you go through here, you'll find that in every case, this is just the midpoint of the bid and asks. This is actually a pretty important number because most of the time when you trade, you can get the midpoint, especially if volatility is high. Same thing for puts. Total volume. This is for total volume of contracts traded today for calls. Same thing for puts. Open interest. Open interest is different than total volume for the day. Open interest represents the number of outstanding options contracts. When an options chain is initially released into the market, you'll find open interest is 0. Okay, so think of this as total volume for that option over all time since it's existed. It's a way to think about it. A lot of you have followed along with, same thing for puts over here. A lot of you have followed along with JP Morgan hedge fund. You'll no longer find its open interest in the SPX series of options because it's got its own futures option. But this used to be where I would see when they entered that trade in the market, was through total volume and open interest later to find out which strike prices they had. This is basically just the order entry area down here, how many contracts I want, whether or not I want to put or call, which expiration am I going to choose, which strike price. Once I've selected all of that information, the bid price and the ask price, along with how many are available on each, show up below. Here I can select limit order, market order, stop order. I can select day or good to cancel. I never change the destination. I don't really care how it gets routed. And AON is all or nothing. Is what that kind of represents.
Peter,
any question?
On the open interest, Peter?
Yes.
So if I, let's say, I bought an option I bought a call.
Yes.
It will now show up as open interest of 1.
Well, it'll show up in total volume first.
Okay.
Okay. So like, let's say in this particular case, if we were to buy a call for December 13th, 2024 of 59.45, it would show a total volume of here. Now the trade actually had to execute. Okay. I could also sell that call.
Yeah.
It still shows up as total volume. Depending upon the broker, it will either show up in open interest at the same time or the next day. Okay.
Okay. And the day I sell that option that I bought, open interest will also come down by 1? Okay.
No, not necessarily, because the only way that the option actually closes, so there's metadata associated with the options that you don't see. So like, let's take an example and say you were the very first, you sold the very first contract that was available for a given strike price on a given expiry. Okay. In the metadata that's associated with that contract that you don't see, there's an identifier that tells you that that was the first contract for that. If somebody else was to sell another one, then there's 2, right? Now, the person on the other side of that trade, usually a market maker, has the other side of the trade metadata. When you go close that contract, it's not that you didn't necessarily close the contract with the same market maker. You following me?
Yeah. Yeah.
Therefore, that contract is still open.
Got it.
Okay. So open interest represents the number of contracts that have not been extinguished, is maybe a better way to put it, because even though you bought it or sold it, in other words, it's no longer in your account, doesn't mean that open interest got subtracted.
Makes
All right?
sense. Makes sense. Okay.
Okay, good. That's kind of a hard concept to get your head around, because in your account it's gone, but it doesn't mean that the option's gone. Okay. All right. Any other questions? That was a good one, by the way. Okay, good. Let's keep going. Options payoff diagrams. This is really what really all about what happens around expiration. Okay. Once the contract has expired, like on Friday, you had a bunch of options. The entire options chain for Friday expired. And whether or not the options paid, won or lost from your point of view depended upon the options payoff diagram. Okay. Basically, this is the P&L of the trade at expiration. The option strike price matters. The underlying closing price at expiration matters, and what you either paid or got paid for the option premium all matter. I give you some mathematics here for how to compute what the profit and losses of the trade for long call holders, short call holders, long put holders, and short put holders. But basically, if you're a long call holder and the underlying closed below the strike price, you got zero. Okay. And you paid and so your net loss was the option premium. Okay, on that trade. If you're long, again, a long call holder, and the underlying price is greater than the strike price, then whether or not you made money depends upon what the premium you paid for the option was. Okay, so let me give you an example. Let's say we bought a call option for $100 on or for $1 with the strike price being $100, and the underlying closed at expiration at 110. Well, then underlying price of 110 minus our strike price of 100 gives us $10 minus the option premium of $1 means that overall we made $9 on that particular option. Depending on the contract size, if it's a standard contract of 100, then we made $900 on that per options contract. If we were short the call, then just the opposite happened. We got paid $1 and lost $10, so we were down $900 if it was cash settled. We'll get to that here in a little while, because in some cases you actually get you're short the stock for that. But if it's cash settled, you lost $900. Puts are just the opposite. And for puts, if you're a long put holder, you want the underlying price to fall below the strike price in order for you to get paid. And again, for the options premium. So again, this kind of works out with the way that we describe these contracts as insurance. Calls are somewhat of either speculation or insurance for the upside. And puts are either speculation or insurance for the downside. Let's go look at a couple of examples. I think I actually did this particular example. Okay, so strike price here is $100. Option premium is $7, which means that the underlying break-even point is $107. Okay, that's where if you're long the option, long the call, you break even at. You need the strike price to be greater than 107 in order to make any money, and it's shown how much money you make here. Notice it's linear, right at this particular point. The most you can lose is the $7. Okay. If you're short the call, well, then it's just the opposite. $107 is where it's $0. The most you can make is $7, but for every dollar above 107, you lose at least $1, and that can go on to infinity. Okay, this is why shorting is considered to be. A lot of people consider shorting options to be picking up pennies in front of a steamroller. I've heard that term so many times that it's kind of, I think it's personally ridiculous since I short options all the time and haven't had a losing trade for years. You have to go all the way back to March of 2020 before the last time I actually held a option that lost in my portfolio. Long puts, just in inverse. Short puts, in inverse. Payoff diagrams are basically just what happens at expiration, and they tell you whether or not you know how much money you're going to make and everything else like that. It is important that you understand how these work. Like if I'm going to make a speculative long call, like let me give you an example. In February, maybe it was March of this year, I've got that 6-month AI calculator out there, and it said that we should be at 7,200 by the end of April, and it turned out to be pretty close to being correct. So in March, when we were, I want to say around 6,500, I bought 7,000 calls, and I went and used the mathematics for the option payoff diagram to figure out what what I would make if we actually hit 7,200 by the end of April, how much money I would receive, and I set that as the limit order to sell the call. Turns out I got that money in earlier in April, somewhere around the 16th or so a couple weeks before the option actually sold. But what I took was the premium I expected if the AI was right. That was just a total experiment to kind of figure out how to go use that particular piece of information and speculate. But this is kind of how you might think about using an option payoff diagram. Okay. Note the yellow box. Yellow boxes always are the takeaways for these slides. For understanding your trade risk and when to get out and when to take your profit, those are kind of important. Questions? All right, we can keep going. Good. Assignment and exercise. We spoke briefly about assignment and what might happen under dividend type of conditions. The last class, and on class number 1, we'll go into that a little bit more here. Options, assignment, and exercise is something that's very important to you, because sometimes you can end up with stock that you didn't want. If it's non-cash settled, right here, as the non-cash settled stocks and ETFs, they settle in shares. There are American and European style options. Does anybody know what the difference between an American and European style option is? I personally prefer European style options. I'll say that right up front. Anybody know the difference?
I'll take a punt on this. With European, they only settle on the end date, whereas American, you can settle earlier, as in like you can exercise, instead of settle. You can exercise. Yeah, earlier. But Europeans only exercise on the end date of the.
Yep, European style options exercise at expiration. American, now who has the right under an American option to exercise?
The buyer?
A long option holder can exercise under an American option. Okay. They determine whether or not they want to have the right to buy or sell the underlying via the option. That's who the long option holder has that right. The person that sold the option has to go take what the long option holder decides. Okay. You gave up that right when you sold the option to them for the premium. It's again, in thinking about it, similar to insurance. the buyer of insurance gets to decide whether or not they want the person that sold them the insurance contract to come out and fix their house or pay their medical bill or something like that, while the buyer can choose to do that on their own if they don't want their premiums to go up later or something like that. Okay. The long option holder has the right to exercise. Under American style options, that can happen at any time, up until expiration. I heard something here that actually under an American style option, they had some right to exercise after expiration too. And I think that and so I'd have to go look at the contracts. You'd have to go look at the specific contract to see whether or not that was true. I remember that came up with AppLovin discounts. You kind of remember that too, because we talked about that. That was when they had crazy premiums, and it closed. The calls that we had closed at 0, but there was some right to exercise after the option in their contract. Just be careful with speculation on highly volatile stocks, because you may end up with shares of the stock that you didn't want. But European style options, only that right only exists at expiration. Okay. Assignment is what happens to the short option holder. I kind of outlined that here. If it's a stock or an ETF, if you shorted a call option, then the long option holder chooses to exercise their right, you then have to take a number. You have to sell them a number of shares at the strike price. Okay. For the long option holder. So like if we were to go back to that example of $100, strike price was $100 and I got paid $1 for it, but it closed at 110. I have to buy or I have to sell 100 shares at I believe $110 for that option holder. I've never actually had shares assigned to me, so I'm not 100% certain exactly what happens in that particular case. But I do know that you basically get short the option in that particular case. If you're short the put, then you're long the option if the option holder exercises that right. Anybody had shares assigned to them? Good. That's not a desirable thing if you're speculating. Any questions so far? Nick, are you still following all of this?
Yeah, I'm following.
All right, good. One of the easiest things to do in options land, we have our own terminology. There's things called strike prices, and there's assignment, and there's underlying, and then there's call verticals and put verticals and all sorts of other things. There's American style options. There's ask prices. At the money. Okay. At the money is when the strike price of the option is equal to the current price of the underlying share. So if the underlying stock was $100 and the strike price of my option was $100, that's called at the money. Automatic exercise is an option that the long holder has. You can choose. I didn't go into that on my screen before, but there's a way to go have it automatic exercise if the option is in the money on expiry on behalf of the long shareholder. Anybody want to give a crack at backwardation? Because next is contango. Backwardation is a futures terminology. Basically, it says that the current price for, say, the VIX. We'll talk about the VIX. The spot price for the VIX is greater than the price for the future 1 month and 1 month in the future. And this can go for 1 to 2, 2 to 3, there's any combination of backwardation that you could possibly have. Contango is just the opposite. It's where the spot price is less than the front month, and that's the normal particular case. Backwardation is somewhat important because when the VIX is in backwardation, it usually means that it's too high. The futures market is anticipating that the VIX will come down in the future, which means selling options at a shorter period of time is more likely to be advantageous to you than selling them later. Black-Scholes is, we already talked about that. Bid price we talked about. We talked a little bit about break even. Buy to open and buy to close are the same thing that they are for stocks. Selling an option is often called writing the option. A buy right is selling a call on a stock that you already own. It's a covered call approach. There's a number of ETFs that do that. CBOE is the Chicago Board of Options Exchange. I don't ever say that. I always say CBOE. You can go through what a clearinghouse is. Collateral is what you need for margin. Let's see, what else is important in here? Day order, we talked a little bit about that. Debit spread, we'll go into that a little bit more. We will definitely cover Delta later. We talked about American style options, European style options, the exercise price. We'll cover Gamma. Good until canceled. We talked a little bit about that. We will be covering Greeks in detail here soon. We did talk about implied volatility. Margin, blah, blah, blah. Naked option. Naked option is when you sell it straight up with no, it's not covered by another underlying security. I don't suggest that if you're starting out that you do this. You should always cover your option in one of the ways that we'll show later. This is a good way to go get yourself hurt if you don't know what you're doing. We talked about open interest. Options Clearing Corporation. The OCC is an unknown organization to most options traders, but they are actually who provides all of the data necessary for portfolio margin. And sometimes that data has errors in it. So don't be afraid to go. If you get a margin call and you're pretty certain it's not real, and you have the ability to back that up in some way, shape, or form, usually it's because the OCC messed up part of their TIMS data. I've had to argue that about 3 times over 15 years. And I was always right. Talk about all of that. This is something, guys, you guys can go study. Note that this is just more or less a reference on terminology. This presentation is available in the information portion under Slay Trader, so you can go look this up at any time. And I think I emailed this to everyone as well. That's why I didn't spend a lot of time covering it, just what was kind of important. Any questions on terminology? All righty. So we covered basically up to this particular point the basics of what an option is and how they work, and what happens at expiration and other things like that. Now we're going to get into a little bit more details. The mathematics gets a little bit harder here. Again, I don't want you to focus. I don't want you to get lost in the math. But it's important that you understand what we're talking about. And I will probably use, well, there's a chance that I will use some terminology that you're not familiar with. So if I do, please ask. we will cover most important thing to understand after this section, after advanced. The most important question I always say is why. Because you can understand what, when, where, and how are, but why? Why does it work that way? Why is this important? Why is it important that we follow a certain procedure, or why do you not want to be a pig? Why is it important for you to manage your margin? I tell you, don't do that. And what does being a pig even mean? Well, being a pig depends a lot on experience. If you have a lot more experience, you've probably already been a pig and didn't realize it, and you got burned for it. So now you have some experience that tells you, well, I shouldn't do that anymore, or I should do something else. I think Kim Greenblatt last time mentioned that you're going to lose money at some point in time trading options, and experience gives you answers to the question why. So in a lot of cases here, we're going to introduce some new concepts, some things that aren't discussed if you take a college level trading class, and it's important to ask why. Options trading permission levels. Okay, this is what you get assigned by your broker. I'm giving you what E-Trade has. I'm certain there's something different for Schwab or Fidelity or Interactive Brokers or Tasty Trade or whoever your broker may be that gives you options trading permissions. But they all are basically the same. The levels that I'm using are just what's associated with E-Trade, who's my broker. Level 1 options approval allows you to trade covered calls and cash secured puts. Okay. A covered call involves holding the underlying asset long while selling call options against it. Okay. So in the case of, I need to have at least the number of shares of the stock as there are in the contracts, the number of contracts that I sell. So for instance, if the contract size for the covered call is 100 and I sell 10 calls and I want to make that a covered call position, I need to have at least 1,000 shares of the stock. Okay. This allows you to generate premium for it. It also gives you a way to get out of the shares of stock, because if you have it automatically exercised, if the underlying exceeds the strike price at expiration, the shares will be taken out of your account and replaced with cash at the strike price level. This is suitable for pretty much for conservative investors. For the data that I provide, we can tell you there's all kinds of information on what strike prices you might want to sell if you want a given probability of having it executed or exercised against you at expiration. Cash secured puts involve selling puts, and it requires you to hold enough cash in your account to purchase the underlying shares if the puts are exercised. Okay. This is a great way of getting into a stock if you have a share price in mind. For instance, let's say, right now I have some stock trading at $80. I don't care what it is, but I would be interested in getting in it if it went down, say 15%. Okay. 15% off of $80 is $12. So that would mean that if the share price hits $68, I might be interested in getting in it. Well, I can sell puts at $68 against that, collect the premium. Okay. If the stock does not reach $68 or close below $68 by expiration, I at least got to keep the premium. Okay. No harm, no foul. I made some money on the trade. If it closed below $68, well, then I bought it at $68, which was what my get-in point was to begin with. So that's how you would trade a cash secured put. Risk that you will be a pig. Note right here. Risk that you will be a pig with level 1 permission. It doesn't exist. You can't really be a pig because everything is secured either by cash or underlying assets. Margin management difficulty. This doesn't exist either. There is no real margin associated with this. As long as you keep the cash in your account necessary to secure the put price or your obligation for the puts, and you keep the shares for your obligation for your calls, there is no margin management difficulty. This is easy. If you're first starting out with options, this isn't a bad way to trade them. Get used to it. Think about what price I would want to own an asset at. Make sure I've got the cash there to go own the asset at that price. Sell the put. See what happens. Don't have to be. I guess the only way you could be a pig with this is if you started speculating here and you didn't actually hold the cash. But under level 1, that wouldn't be allowed. Okay. Oh, by the way, I don't know that there's even any experience requirement for getting level 1 options. I think every trader gets level 1 options if they ask for it. Anybody know if that's wrong? Discount, do you know?
Yeah, never had issues getting level 1 without any. Easy.
Yeah, I don't think there's no test or anything else that goes along with that.
No.
That I know
I
of.
think it may be more of a question of with the account to keep $25,000 minimum or something like that. It's not related to risk at that point. It's more just, can you keep the balance, I think.
Yeah, maybe. I don't know. I've never run into an issue with level 1.
Yeah, means even like I have level 1 approval in IRA accounts that you also get without any issues.
Okay, good. Level 2 options provide all the capability that level 1 has, plus the ability to purchase long options. Okay, so here I can start to speculate a little bit. If we go back to the payoff diagrams for long calls and long puts, remember my only risk is in the premium. Okay, so I can speculate on upward price movements. I purchase long calls and long puts as speculation. Here recently, I've purchased long puts in anticipation that the market's going to go down. And it will eventually. But my long puts are really less against the market going down as opposed to the VIX going up, because that'll affect the price more than the underlying will, more than likely. But purchasing long options gives you the ability to speculate. You can't really sell. You're able to. In other words, you're able to purchase insurance. You can't sell it yet at this particular level. Risk that you can be a pig, yeah, it's modest because you can go a little bit overboard on this and lose money trading long options. And I'll argue that if you try to go purchase long options, unless you're a really, really, really good trader, you're more than likely going to lose if all you do is trade long calls and long puts. I hate to say it, but I don't know anybody that has been long only in terms of puts or calls that makes money over the long term. They might on one or two given trades. Like if you happen to be fortunate enough, my son was one of this. He owned long calls on GameStop from December 2020. And if you remember right, in January 2021 was when GameStop mooned. He got out when he doubled his money. He could have made, I think, 100,000 to 1 on it, and would have been a very rich man if only who would have known. But he got out when he doubled his money. Margin management for this, I write modest on here. I don't really know that you can't, if you purchase too many long puts or long calls, I suppose you could get yourself in margin difficulty. That's kind of hard to do that though. Again, don't be a pig. Level 3, Level 3 gives you the ability to trade spreads. And this is the first level at which you have the ability to begin to sell insurance via a spread. A spread is when you sell a strike price. Let me give you a put example. So if the underlying is trading at $100, I want to sell a spread, I can sell for a put spread, and I want to speculate such that at expiration it'll be at zero. I can sell a put at $80 and buy another put at $78, so that my net potential loss is only $2 if the stock actually went below 78. Okay, that's what a spread is. Selling a higher strike price, and then buying a lower strike price for speculating that the stock is going to be above that. You can also sell spreads if you want for speculating on the long side, where you just invert the two. So I buy the $80 and sell the 78 to reduce the price of the $80, but the most I can only make is $2 there. Reg T margin requirements are applicable here, so that you're limited in the number of spreads that you can potentially sell. I'll let you go. I don't know if I think I do go over Reg T later in this presentation. So we'll talk a little bit about that. You can look it up on your own. Basically, Reg T margin limits the amount of spreads that you can sell based upon the size of your brokerage account, and there's also house margin rules and things like that from your broker. Sometimes complex spreads are allowed here, something like an iron condor, which is where you sell a spread of calls and puts at the same time. And there's other things that we'll go through here later. Risk here that you could be a pig, it's somewhat moderate. The only reason why it's moderate is because of the Reg T margin requirement. Margin management difficulty here is again moderate because of the Reg T margin requirement. You can't really hurt yourself too bad with level 3. But this is the first time that you can start to sell options in a spread environment. And this is something that everyone here in this class should aspire to get to at one particular point in time or another. I always tell people that think about a trading account. Let's say you have a $20,000 trading account and you can get a level 3 option permission on it. Okay, and that $20,000 trading account has a long stock portfolio. If you could make $10 every day trading option spreads, okay, on top of that stock portfolio, that $10 every day will add $2,500 or at least $2,500 to your $20,000 at the end of the year. Because there's 250 trading days. $2,500 on top of what you made in your stock portfolio. Not bad to get a 12.5% return on just selling options that are relatively low risk. And you get that with the data that I provide every day. Level 4 requires a reasonable amount of experience. I think E-Trade requires you to have, first of all, E-Trade is a pain in the ass to go get a a level 4 options trading permission level with. This is basically what portfolio margin is used, is required for portfolio margin. You have to have at least 15 years of experience. They usually like that 15 years of experience to be trading at least level 3 with them. So if you have 15 years of experience trading level 3 with Schwab, it doesn't count. I don't know if any of you guys have had difficulty getting level 4 options trading permission with E-Trade, but I can tell you right now, it's a pain in the ass. I've done 15 years with those guys and recently opened a new account, and they still complain about it. I don't know why, but they did. They did give it to me, but I think that now that they've gotten bought by Morgan Stanley, they're a little bit more risk averse, if you will, so to speak. Level 4 options is where you can get yourself in trouble. This is where being a pig, and I need to fix that. The risk of being a pig is very high. Margin management difficulty is high. Again, having all of that experience is high, but level 4 capability is also where you can make the most money. And the compatibility with the data I put out is extraordinarily high here. Portfolio margin accounts are used by professional traders or people with an awful lot of experience. Don't ask for a portfolio margin account. If you're new to options, go start with gain some experience through the other 3 levels first. Get comfortable with what you're doing there. Get yourself in a little bit of a rhythm and understanding how options actually work in that level before you move up to level 4. It's my understanding that tastytrade in particular will take almost anybody and give them a level 4 options trading capability. Is that, anybody else know if that's true?
I think the internet's littered with people over on Instagram and Reddit with those examples. So yes, I think you're right.
Yeah, just I'm going to tell you to avoid, if you're not ready for it, if you're not ready to trade level 4, and you don't know how to go compute your own margin and things like that, you are being a pig by moving up to that particular level. It's better just to stay at 3. And if you can go make money doing level 3 and you're comfortable doing that, keep doing it. Nothing wrong with that. Move up to level 4. If the first time you do, you still probably want to trade spreads. Level 4 allows you to trade naked options. This is the only one that does, which is why you can be a pig. So be careful up here. If you want to move up and you've been doing level 3 for a little while, in the blind squirrel thread, there's all kinds of people there that can give you suggestions on where to go get a level 4 account. I think most of the traders use Schwab, but that was because they started off with TD Ameritrade beforehand. So but this is the level that if you want to really go make money with options, this is what you want. But at the same time, the risk is very, very high here. All right, Reg T versus, yes.
Sorry. So regarding the tastytrade, actually, so I'm using it a lot, and it's very easy. Yes, it's very easy to get the level 4 options, but be careful. So sometimes it's hard to get in touch with their customer service during the trading hour. I almost always have to go with email, but email is slow. When you call them, sometimes most of the time they couldn't pick up your call, or you may have to wait for a long time for the call. Actually, that's the issue.
tastytrade's a smaller broker, and they do specialize in options. That's one of their things. Interactive Brokers claims to do that too, except I personally, I used to trade with Interactive Brokers some time ago. My biggest issue with Interactive Brokers is they have some house margin requirements for portfolio margin that are nonsensical. And you cannot compute via Black-Scholes or any other methodology your next day margin. Okay, it's not possible. Even they can't compute your next day margin. And if you're trading portfolio margin, I already know what my today margin is. I need to know what it's going to look like tomorrow in the morning after today's options expire. I don't care about today. Today, I already know. If I had a portfolio margin issue today, my broker would tell me that. But I want to know what it's going to look like tomorrow when today's options expire. And Interactive Brokers was never able to give me that level of information because of their house margin rules. If you trade with Interactive Brokers, don't get portfolio margin from them. They're fine through level 3. Try to go get it with Schwab or Fidelity or another broker. That would be my suggestion. Since this will go on the internet, I hope they don't sue me for that statement.
Trust me, you won't be the first one bitching about them.
Well, I mean, I quit them over that. So, you know, and they can, their customer service can never tell me how I was supposed to compute it. And like, well, okay, you know, you guys aren't the only ones that do this.
On the previous point, Peter, just like, if at least on Schwab, if you have a portfolio margin account, you get like a dedicated margin and risk line that you can reach out like within a matter of minutes.
Yeah, E-Trade has that too.
Yeah.
You get associated with their portfolio margin team. Okay, portfolio margin. But let's talk about the portfolio margin versus Reg T margin. In portfolio margin, the positions in the portfolio margin against themselves. Okay. So if you have a stock position and an options and options positions, and let's say you're long stock and short a call, the short call represents a short position in the market, and the long stock is a long position in the market. And those two things margin against each other in a portfolio margin account. At the same time, I can be short puts at one expiration and long puts at a different expiration, and those two margin against each other. So portfolio margin margin is computed based upon what your portfolio contains. Reg T, on the other hand, does not. It is based upon, Reg T margin is based more upon individual trades. There's a table of different things that go on here under Reg T margin versus portfolio margin with what the difference is. Portfolio margin doesn't have any difference between initial and maintenance margin. So if you look up margin, you only get one. Whereas for Reg T, you've got two different margin requirements. Again, I'll let you just go look through this table separately. If you're level 3 and below, you care about Reg T. If you're level 4, you care about portfolio. Any questions on this? All righty. Any questions about the levels of options trading accounts in general? Okay. Greeks. What time is it, guys? Just, I can't see my
8:04 Pacific time.
8:04?
Yeah. So it's 11, right?
Yeah. We should probably stop here because we're going to eventually end up in Vanna, and I know we'll spend a lot of time on Vanna hedging and option Greeks and stuff like that. And that'll go on for another 40. We could spend 40 minutes on this topic alone. Is this a good stopping place for you guys?
I'm good. I was going to just ask, where can we get the links then also for the videos? Were you sending them over in the Discord?
Oh, so go to YouTube, look up Peter Snowart, lowercase, no space. So youtube.com, Peter Snowart, lowercase, no space between Peter and Snowart. Just search for that. Now there you'll find the video.
Thanks, Peter.
Okay. Let me stop sharing. All right. Excellent. Any other questions, guys?
Thanks, Peter.
Thanks, Peter.
Okay.
Yep.
Have a good
Thank
one,
you, Peter.
guys. Take care.
Thank you, Peter. Bye-bye.